Today, we're talking about the Insured Retirement Plan for Canadians. Now, what if I told you there's a financial strategy that allows you to grow your wealth tax-free today, access cash when you need it, today or tomorrow, and then retire with a steady stream of income later without worrying about market volatility? Now, what if this same strategy could also be used to protect your family's financial future and to help you leave behind a guaranteed tax-free legacy? So most Canadian business owners or professionals have never really heard of this, but you can talk about the Insured Retirement Plan. It's one of the best kept secrets for wealth building, for creating tax-efficient retirement income, and for securing your family's financial freedom. Hi. My name is Laurent Munier, and I'm a partner here at Safe Pacific Financial, and we've been helping incorporated Canadian business owners and their families grow their wealth and help them to leave a legacy for their families for more than a decade. Today, we're going to talk about the Insured Retirement Plan, or some people call it the IRP. So this is a plan that can unlock financial freedom today while you're working, and then tomorrow when you want to retire, and really at the very end when you want to leave a legacy for your family. This is a quick guide for Canadian business owners that you're probably not going to find anywhere else. So the Insured Retirement Plan is an ideal follow-up strategy for the IFA, or the Immediate Financing Arrangement strategy. We've got a lot of videos about the IFA, Immediate Financing Arrangement, that's on our website. It's also on our YouTube channel. I'll link them below. What we're going to talk about today is we're going to start with who is this Insured Retirement Plan. I'm going to just call it, who's the IRP strategy for? We're going to talk about how does it work? And we're going to talk about some of the benefits of setting up an IRP strategy for business owners in Canada. And then I'm actually going to show you a sample illustration with real numbers. And then we'll talk about also some risks and pitfalls that you need to avoid if this is a strategy that you're trying to do for yourself. So, are you a good fit for the Insured Retirement Plan? It might benefit you if you are you're a high income earner, and you're earning more than, say, like $150,000 per year every year. If you're in good health and you can qualify for insurance in Canada, if you've maxed out your other retirement accounts like RRSPs and TFSAs, or if you have a pension plan, or however your other retirement funds are set up, and if you own taxable investments, so non-registered stocks, real estate, business assets, and you want to reduce your tax burden. Also, you want to access tax-free cash flow in retirement without triggering capital gains taxes or without affecting other income-tested retirement systems, right? So your CPP or OAS and things. Also, you should need life insurance, right? Because we're setting up a life insurance policy to do this. So you want to protect your estate. You want to leave a tax-free inheritance to your family and to your beneficiaries. If you don't like life insurance, turn off this video now. This is not a good situation for you. I'll just tell you that right now. This is also a good idea for you if you don't like market volatility and you want a secure, predictable retirement income stream that doesn't get eaten up by tax. Also, if you prefer to keep control over your own money instead of relying on government programs like CPP and OAS, or maybe we have actually a lot of clients that maybe don't fully trust government programs are run the right way, and will they even be there for you when you hit that age of retirement when you want to start accessing. Why is this Insured Retirement Plan a smart strategy for high-income Canadians? So many high-income Canadians, they really find themselves in a tax trap when they reach retirement. So if you hold most of your assets in an RRSP, or you have non-registered investments, or you have your business, there's significant tax consequences when you want to withdraw those funds to spend in retirement. So let's consider. Your RRSP withdrawals are fully taxable as income when you take them out. So this could push you into a higher tax bracket. It's also going to really eat away at the amount of money that you think you're getting in your pocket to spend. Capital gains taxes on investments and real estate really erodes your wealth and are a significant drain when you're trying to build up wealth to live on during retirement. And then you have your non-registered investments. So this could be your dividends or your interest or rental income or portfolio, whatever. Those are taxed every year. And again, those taxes just kill your returns, and they kill how much you think you're going to have in your pocket to spend in retirement. And then at the end of the day, so this isn't retirement, but this is your estate. There's nothing called specifically an estate tax in Canada, but there is what's called a deemed disposition on death. And if you don't set up your estate properly, this can take up to 50% of your assets and send them to Ottawa so that Ottawa can choose where your money goes much better than you can. So if that's something that you want to do, don't make an estate plan. So your insured retirement plan, this provides a solution to all of these problems that I just talked about. It also lets you, number one, grow your money in a tax-free way inside a permanent life insurance policy. It lets you access that money for spending in retirement through various types of loans that we'll talk about. It also reduces your reliance on taxable investment withdrawals, so it helps to keep your portfolio intact. And then it leaves a tax-free death benefit to your heirs, to whoever you want your beneficiaries are. So, and then this could be used to cover taxes like capital gain taxes on death, and it ensures a smooth wealth transfer. So the money will go from the insurance policy to whoever you say, with nobody in the middle to stop that or make any changes. Now, when do you want to set this up? So if this is something that you want to do, how long in advance do you need to do it? So the IRP is not a last-minute retirement strategy like most financial strategies. This requires planning and it requires time to optimize the benefits. So to maximize your tax-free cash flow and to build up a substantial policy value, I would recommend you start at least 10 years before you plan on retiring, and the longer, the better. And the reason why is that you need to contribute consistently over time into this policy in order to accumulate these cash values. And do your best to ensure that you're in good health so that you can actually qualify for the insurance in the first place, right? So the earlier you start, the more financial flexibility you're going to have in retirement. So if you're 10 years or 15 or 20 years away from retirement, now is the time to look at an insured retirement plan and see if it can protect your wealth, optimize your taxes, and create a legacy for your future generations. So how does this thing work? I'm going to break it down step by step. I'm going to go over some of the benefits of the strategy. So first step, number one is you need to set up the insurance policy that's going to run this whole thing. So the foundation of the insured retirement plan is a permanent life insurance policy. And specifically, it's a participating whole life insurance policy that would be issued from a major Canadian life insurance company. We work with Sun Life, Manulife, Equitable Life, Canada Life. There's a bunch of different options. And really, there's no best company. The best company is going to be the one that suits your needs the best. And this is something that we would figure out as we work with you. So, just in this video, I can't tell you who's the best for you. I have no idea. After we meet and you give me some information and tell me what you're trying to do, we will find the company that fits best to give you what you want. And so why are we using a whole life insurance product to set up these IRPs? So a couple reasons why we're using whole life and not other types of insurance. So number one is the guaranteed cash value. So once the money is inside your cash value, it becomes guaranteed. It becomes what's called immediately vested. So it'll never go down. Also, a whole life insurance provides stable and predictable cash value accumulation over time. And so this grows from your premium deposits, but also it grows from a dividend from the insurance company. And the dividend payments that many Canadian life insurance providers pay, these are annual dividends, which increase the policy's cash value. They also increase your death benefit, the way that we set them up in the way that we structure these policies. Now, again, you have permanent coverage. So unlike term life insurance doesn't build up cash values. So you can't use it to do this insured retirement plan. You need to use type of insurance that has cash value. And that's why we choose the participating whole life insurance. So now there are tax benefits, and these are really important. So the cash value inside the whole life policy grows tax deferred as long as it stays inside the policy and as long as it stays within the CRA's MTAR limits, which is your maximum taxable actuarial reserve. So you can look up MTAR if you're one of those people that really wants to research this thing. And so the way that we're going to structure this policy for you, if this is something you want to do, we're going to make sure that we stay within the CRA limits to make sure that this thing stays on board. The reason that we use these whole life policies, it also provides a more tax efficient alternative than taxable investments, such as your non-registered portfolio, stocks, bonds, potentially real estate. And that actually It doesn't have to replace these things. It works really well in conjunction with. If we are going to try to get a lot of views on YouTube and we need to pick and say, oh, you only can do this and all these other things are bad, that's not how we play on this channel. You should do both. You should have a stock portfolio. You should have insurance. You should probably have real estate. You should have all these things, and none of them are bad, and none of them should replace the other ones. So that's step one. This is how you set it up, right? You set up the policy, and this is why we use these types of policies. Step two. So now you want to accumulate your tax preferred growth that's inside the policy. So once the policy's set up and you funded it with your first premium and your second premium and your third premium, so over time, your policy's cash value grows without the tax inside, which increases your financial flexibility in retirement. And how does it grow? So as you're making your premium deposits, so you're contributing to the policy's cash value, you're buying a little bit of insurance and some of it's going to cash value. And then you also are getting dividends from the insurance company, which are then reinvested to purchase more coverage, which boosts the policy value, which gets you a higher dividend, which gets you a bigger death benefit, which gets you a bigger dividend, which gets you a bigger death benefit. These are called paid up additions. So it's an option that you can add to a whole life policy. And this is what really supercharges the cash value growth. Now, another great advantage is that there's no annual tax reporting required for the cash value growth unless you're withdrawing the funds. So again, like we said, there's no tax issue as you're growing this thing over time. Now, how long do you let the policy grow? So for the maximum benefit, your IRP strategy, like I said, it should be implemented a minimum of 10 years before you want to retire so that you have the ability to grow the cash before you need to use it. This ensures a significant cash value accumulation, and this will get you the most amount of tax-free income later in life. Step three. So how do you access this tax-free retirement income? And the way you do it is through collateral loans. So one of the biggest advantage of the IRP strategy is that you don't need to sell assets and you don't trigger any sort of taxable withdrawals to access this money in retirement. Instead, you borrow against the policy cash value from a third-party lender like a bank. And then how does this work? And how complicated is it? And do you have to do a bunch of work or do we do it all for you? About to answer that. So what you do is you take your whole life policy that has the cash in it and you pledge it as collateral to secure a series of loans from the bank. Since these loan proceeds are not taxable under the Income Tax Act, they provide tax-free cash flow in retirement. You can withdraw your funds from the policy at any time. That does expose you to tax, right? So this is why we're doing loans versus withdrawals. So you can take these loans for any purpose that you want. So it could be for your lifestyle, it could be certain expenses, traveling, even investment opportunities or other financial opportunities. This question comes up a lot. You're probably also going to see some negative comments about this in the comments down below. But why do you borrow against the policy versus withdraw from the policy? So let's talk about the RRSP where you have to withdraw. When you withdraw from your RRSP, that is fully taxable, meaning that you are going to pay income tax on whatever you take out from your RRSP, and it's going to be at whatever your marginal tax bracket is at that time. If you wanted to retire by selling some real estate, well, selling your real estate or selling other investments probably is going to trigger capital gains. So again, whatever money you receive, you're not going to get all of that. A big chunk of that is going to go to Ottawa and to your provincial government because they want taxes. When you take the loans against your life insurance policy for this insured retirement plan, it doesn't increase your taxable income because it's a loan. So this lets you keep more of your own money in retirement. And now, how much can you borrow? So the banks, the Canadian banks, will typically lend anywhere from 75 to 90 to 100% of the policy's cash value as a loan. And the loan repayments with this insured retirement plan type of loan is optional. So any unpaid loan balance gets settled when you die, right? So what happens is, say you want to take $100,000 a year as your income in retirement. You take a loan for $100,000 this year from this bank, and then next year you take another loan for $100,000. Next year you take another loan for $100,000. For easy numbers, you retired at 65 and you died at 85, so you needed loans for 20 years. What's going to happen is you've got your cash value. The bank is lending you money against that cash value. They are charging you interest, but what they're doing is they're adding the interest to the loan. So you're not out of pocket anything during these 20 years from your age 65 to 85 when you conveniently pass away right on time. When that happens, the policy death benefit pays out the entire bank loan plus any interest, and then the remainder of that money would go to your beneficiaries, whoever you say. So you were able to spend all that money throughout your life and still leave something for your kids or to whoever you want. Step 4. There's the tax-free death benefit that pays out the outstanding loans. This is kind of what I just talked about here, and it leaves the inheritance. So this is one of the major concerns, like one of the biggest concerns for retirees is running out of money, and also what happens to their estate and their remaining assets after they pass away. So with the IRP strategy here, your life insurance policy's tax-free death benefit ensures the financial security of your beneficiaries. So what happens? Let's walk through this. The tax-free death benefit covers any outstanding loans, including interest, so it pays out the bank completely. Any remaining death benefit is paid tax-free to your heirs, and it doesn't go through probate, and it doesn't go through any sort of taxable estate. Your family receives this financial legacy without any CRA deductions, which is very unlike non-registered investment accounts or real estate. So for an example here, say you've accumulated $1.5 million in cash value inside your policy, and you borrowed $1 million throughout your retirement. So when you pass away, the insurance pays off the $1 million loan to the bank. The remaining $500,000 is part of the death benefit. So more than that amount is going to pay out to your beneficiaries. How much? I don't know, because we have to run specific numbers for your situation, but we would be able to tell you that if we meet and run these numbers. What does that do? That ensures that even after accessing tax-free income in retirement for all of those years, your family still inherits a significant financial benefit. So now, what are some of the key benefits to the Insured Retirement Plan in Canada? Or actually, I said I was going to say IRP, so it's IRP. Lots of benefits to this strategy, but these are really the most important ones. Number 1 is the tax-preferred asset growth. Because there's no annual payable, tax payable on the cash value growth, as long as the policy stays within your MTAR limits, this allows it to compound tax-free for a long time, leading to a greater long-term wealth accumulation. This also outperforms traditional taxable investments, such as savings accounts or even non-registered portfolios, because you're not paying the tax every year. This will give you also tax-free access to retirement income when you choose to retire. So these collateral loans that you're doing with the bank, they're not treated as income, so they're not subject to taxation. Another benefit here is you don't have any forced withdrawals, right? So when you do have your RRSP at age 71, you're forced to convert that to a RIF, an RRIF. So that forces you to withdraw money from your RRSP, whether you need it or not. And again, increases your taxable income in those years, and you're not going to get all of that money because a big chunk of it is going to go to the CRA. What else does this give you? It gives you huge flexibility to access this money on your terms without capital gains taxes and without mandatory deductions. Number 3, there's also an alternative income option. So these collateral loans are really efficient ways to get the money from your policy. But with an IRP, you can also do other things. So you could take policy loans directly from the insurance company. Here, they may be taxable depending on when you set up the insurance and depending on what is your adjusted cost base. So you need to be on top of it if you're taking the loans from the insurance company directly, and you need to work with somebody that really knows what they're doing, because you could be setting yourself up to get taxed. You could also make withdrawals from the policy cash value. Again, withdrawals could be taxable, and it could also, because you're withdrawing from the cash value, that's now no longer compounding for you. So your growth is going to be slower. And then you potentially have tax deductibility from the collateral assignment. So this is something you want to talk to your accountant with, but the loan interest may be tax deductible if you're using the fund for income generating investments. Again, I'm not giving you tax advice. Your accountant is going to give you tax advice, but send this video to your accountant and say, hey, does this work? Some of the life insurance premium may also be deductible. It's called your NCPI. It's getting really technical into the weeds, but yeah, part of the premium may be deductible. So as an example, if you use the loan proceeds to invest in a rental property or a business, you may get tax deductions on both the loan interest and on the life insurance premiums. Again, may, and let your accountant tell you whether that's happening or not. Don't trust me, random guy on the internet. I'm not giving you tax advice right now. And number 5, a big benefit is the private tax-free estate transfer. So the death benefit is paid tax-free to your beneficiaries. This avoids probate, this avoids the CRA, this avoids any sort of estate taxing, and it ensures that the wealth, the maximum amount of wealth, stays within your family. And it also can give a larger after-tax inheritance compared to transferring taxable investments to your family. And so now I'm going to give you some numbers. So for a quick heuristics, or heuristics is rule of thumb, your minimum budget for something like this should be an annual deposit of $50,000 or more for at least the next 10 years. So if this is not something that sounds good to you, this is not a good idea for you. Ideally, it's going to be in the hundreds of thousands or more for 10 years because that opens up your lending opportunities and it gives you access to more banks and more services. So you just have way more flexibility. The way that we figure out these numbers is we work backwards with clients from their desired annual cash flow. So for example, if you want to retire with $100,000 a year after tax, we take that number and we work backwards and tell you, okay, this year, this is how much you need to deposit so that in that future year, this is what you can see. So I'm going to show you some illustration numbers. This is with Sun Life. This doesn't mean you have to go with Sun Life. This is just the illustration that I'm showing you. This illustration is specifically for a 40-year-old that's going to be saving $250,000 each year into this plan for 10 years. So the 40-year-old is going to be 50 by the end of this. And then they're going to take a retirement income at a standard retirement age of 65. And they're going to take that retirement income until age 90. So they're going to take that retirement income for 25 years. Now, you're going to see in the scenario, we're going to call him John. John puts $250,000 a year, gets about $5.3 million of life insurance. So the cash is going to grow and the life insurance is going to grow over time. After 10 years, John's 50. John has put $2.5 million into the policy and John has $3 million cash and $11 million of life insurance. So after year 10, so when John's 50, John never puts another dollar into this plan, but the cash value and the death benefit continue to grow. So now John is 65 and wants to retire. He's got over $6 million of cash in the policy and $12 million of death benefit. So this cash value was growing for him the whole time without him having to do anything. Actually, that's another benefit of these types of policies that I didn't talk about. You know, people talk about passive income. Nothing is more passive than holding a piece of paper that says life insurance policy at the top, right? You don't need to do anything. You don't need to buy it or sell it or time the market. If you're talking rental properties, you're not changing toilets, you're not painting, you don't have renters, you're not changing the roof for people. There's nothing you have to do here, right? So that entire time from John age 50 to 65, he didn't do anything except for not lose this piece of paper. So at age 65, John takes this policy to the bank and he wants to set up his Insured Retirement Plan loan. So in this scenario, he can get $332,000 tax-free every year for the rest of his life until he's 90. And so you can see this on the chart here. It's called annual loan values. It's the column. Then when he passes away at age 90, he would have borrowed $17 million from the bank to fund his retirement, and he spent that money on whatever he wanted. That will totally get paid out from his life insurance proceeds, right? So his life insurance at this time at age 90 is $22 million. And you can see that in the policy death benefit column. And then the remainder, $4.8 million, is going to pay out to his beneficiaries quickly, privately, and tax-free. So what happened? How did this work? John funded his retirement for 10 years. From age 40 to 50, he put the money in. Then he took tax-free retirement income for 25 years. And then when he passed away, $4.8 million was paid out to his kids or to charity or school or church or whoever he wants, whatever his beneficiaries are. So this sounds great, obviously, but there are risks to this strategy. Same with any other financial strategy. So, here at Safe Pacific, one of our values is that we're very straight up. I'm not going to dance around the risk. I'm going to tell you. First, the strategy involves maximum funding a life insurance policy. So some people don't like life insurance and some people don't want life insurance. So this is obviously not a good idea for you if you don't want or need life insurance in the first place. And I'm not going to waste your time or my time trying to convince you that life insurance is a good idea. If you don't want life insurance, don't do this strategy. We've actually had it. Somebody wanted to get all the tax and leverage benefits of this strategy and was trying all sorts of things to figure out how to get rid of the life insurance part. But that doesn't work because life insurance is the underlying core of this entire thing. So if you don't want insurance, don't do this. And then, like I mentioned above, the budget for this is something that would be a 5 or 6 figure annual premium deposit for at least 10 years. So if this doesn't sound like something that you can get behind, this is probably not for you. Another risk is taxes could change. So currently, the Income Tax Act of Canada does not treat collateral loan proceeds as income. So these amounts are tax-free right now. But tax laws are subject to change, and the tax treatment of loans or interest deductibility or life insurance proceeds may change between now and the time that you want to retire, right? So in John's case, we're talking he started this at 40 and he died at 90. That's like 50 years that he had this plan going. So things can change in 50 years. Another risk is that you might not be able to get a loan in the future. So your ability to get this Insured Retirement Plan loan against the cash value, it's a collateral loan. So it's not guaranteed that you'll get this loan. It will depend on your ability to qualify for the loan and for the lender's willingness to give you the loan. Also, another risk here is that when you start taking the income, you're locking in everything. So when you're funding the plan, you have a ton of options and a ton of flexibility with what you can do with the insurance policy and the different values. But when you want to start the retirement income part of the plan, when you want to start receiving money, a lot of the flexibility goes away because once your policy has been collaterally assigned to the bank, you lose a ton of flexibility in what you can do. So you can't withdraw funds, you can't take policy loans, you can't make changes to the policy without receiving the lender's consent. So the bank has to say yes to you doing anything. Another thing that might happen is you might need to put up additional collateral in the future to get the loans that you want. So the maximum amount that you can borrow without requiring additional collateral will be limited by the lender. And it's different depending on the lender that you work with. So this bank might give you this bank might give you that. And that's where you want to work with somebody like us who knows which bank might be the best for you. But whatever the bank lends you is going to be a percentage of the cash value. Another risk is that if the policy doesn't perform the way that we illustrate it, that will impact how big your cash values are and how much lending that you can access in the future, or even maybe potentially you have to put up additional collateral. Another big thing is, like, we're talking about loans here. So there's interest rate risk. The interest rate that you will pay on the loan is not guaranteed today and it's going to fluctuate. So generally when we're setting up these things for clients, the loan is based on a floating rate in Canada called prime. So we have clients at prime and prime plus 0.25, prime plus 0.5, but prime goes up and down. So you might be paying this percent this year and that percent in a following year as this happens. So this may use up your cash values more quickly or more slowly. We don't know because nobody knows what interest rates are going to be in the future. But higher than expected interest rates may cause your loan to policy cash value percentages to exceed what the maximum the bank wants to give you, right? So the bank might ask you for additional collateral, or they might adjust how much they're going to lend you each year. Oftentimes, we're going to introduce this concept or strategy to somebody, and they're not ready for it now, but they're still building and they're on a trajectory that they're going to have this type of money in a couple of years. And then when they're ready, they reach out. So, if that's your situation, that's most of our clients' situations. Usually what happens is that they watch these videos, they learn that these concepts are even possible, and they're like, yes, I want to do that, but I don't have $100,000 a year right now to put into one of these things. But 2 years, 3 years, 4 years, 5 years down the road, they call and they're like, hey, Laurent, that thing that you made the video about a couple of years ago, I want to do that. I'm ready now. That happens a lot. If that's your situation right now, as you're watching this, you're in the same boat as a lot of people, right? And then because, like you need to know that this exists today so that you can plan to have it tomorrow. If this is something that you do want to set up for yourself or your business or your partners, reach out. We're very happy to chat to see if we're a good fit to work with you. The way that you reach out, fill out the form. It's on safepacific.com. That's our website. Somebody from the team will get back to you in 24 hours on business days, and we'll set up a meeting. We're licensed all across Canada. We meet clients all across the country, and we communicate mostly via Zoom, phone, email. So if you're in, you don't have to be in Vancouver to work with us. Now, if this video got you value and you learned something about the Insured Retirement Plan, please do me a favor, hit the like button, leave a comment below. Whether you're happy with it or not, that's fine. Share it with somebody, a business owner that you think might benefit from this, because all of those things, clicking all those buttons tells the algorithms and the robots that you like this video and that you want more business owners like you in Canada to see this and learn about these strategies that really you're not going to find out about anywhere else. That's it for me today. I will see you next time.